Okay, good morning, good afternoon, wherever you're watching this. You're very welcome to another Coffee Microcaps Fund Manager interview, and I'm delighted to be welcoming back channel favorite, friend of the Coffee Microcaps project, Peter Johns from Westferry.
Thanks very much, Mark.
And for anybody who's been following us for a while, I think this is Peter's third, interview with us. Yeah, the West Ferry Fund has been going for a couple of years now. But Peter, for anybody who maybe hasn't come across the West Ferry Fund, maybe just a quick bit of background on the fund and the investment strategy underlying it.
Thanks, Mark. I've been running a predecessor fund from as far back as 2016, but Westferry came into being in the start of 2021, so it's 4.5 years old now. Over the longer term, we've had really good results. A couple of underwhelming years the last couple of years, but I think it stems from what is a pretty eclectic mix of assets that we're in. So we're different from most funds in that I'm not trying to build a fund management business. The Westferry Fund is the only fund that we run. Um, all of my investable assets are in the fund, so I own about 16% of the fund. It's around 21 million in assets at the moment, and as I say, it's a mix of things. Because it contains all of my assets, so I like to spread them over a mix of sectors. In the listed space, which makes up around 40 to 45% of the assets, we're very much focused on the microcap end of the market, which is where my investing history lies. We hold four really good key core unlisted holdings at the moment. The underperformance the last couple of years, I think, probably stems from my movement into the unlisted space, which had a checkered start, but we're at a point now where we've culled out the underperformers. We're left with those four really good companies, which I might speak about on another occasion, which are all profitable and cash generating for us now. Finally, we also invest in other fund managers. So part of what I think makes us work well over the longer term has been the relationships I've built up, sometimes through coffee microcaps, but in other forums with other up and coming fund managers. So probably 10% of our assets are invested in other up and coming fund managers, as well as the upside we get from their performance. That always also creates this sort of network of information. I feel far less guilty shaking these people down for information, having at least given them some money to invest and earn fees on. So it creates this sort of real matrix and network of feedback of information of tidbits that are coming from small microcap companies that I think would be otherwise hard to put together.
Yeah, like I said to the prime value guys last week, having a network in the microcap space is very important because I think there's 1,500 names capped under 400 million. So, I mean, it's impossible for any one team to keep on top of every story and every change and every like underlying business. So, having a
Yeah,
network in the microcap space is crucial. And I'm glad to hear you met some of these fund managers or up and coming guys at Coffee Microcaps. That was one of the goals when I started Coffee Microcaps, especially
yeah,
the in-person conferences was, a forum for a physical forum where, we could get a bit of networking going and a bit of community building going instead of everyone just dialing into webinars and not really seeing someone else in the space unless they happen to be at the same AGM. I mean, AGM attendances these days don't really draw big crowds. So I'm glad to
yeah.
hear
It
that
works
that
well.
part of the Coffee Bike Caps business has served some purpose. But we've got you
Hmm.
on here to talk about two stocks in the portfolio now on the listed side. As you said, there's a bit of unlisted in there as well. The first one, SDI Limited, been around for a long time,
It
and
has.
it's kind of waxed and waned. But I think a good business, profitable, pays a dividend. You can't say that about too many microcap stocks overall. And if we take those 1,500 names capped under 400 million, they'll be in the minority for that point. But for anybody who maybe hasn't come across it during the years, maybe just a quick overview of what the business does.
Thanks, Mark. First of all, it's a family-run business. Both the businesses I talk about today are family-run. It has been around a long time. It's been listed a very long time. Um, Part of what I'll speak about is the fact that I think it is nearing something of an inflection point, which has been a long time coming. But in short, it develops a very narrow range of dental products, and more specifically, those products. Well, its history lies in the development of amalgam. So amalgam, for most people, would be known as like a silver-colored filling in your teeth. It's an amalgam called that because it's an amalgam of different types of metals. Unfortunately, one of those metals is mercury, and because of that, even though it's there's plenty of evidence that it's safe in terms of its breakdown, it has been slowly banned over time, and that ban will kick into effect in Europe shortly and in the US thereafter. So um, over time, this has been flagged. SDI has developed, and they have a significant R&D part of the business. They employ a lot of in-house scientists and technicians, and over time they've developed a series of replacement products for amalgam. So what they call in their presentations aesthetics, which are essentially different forms of compounds that are white in color or tooth colored, that serve as a replacement. In most cases these days, a superior replacement to amalgam. And then finally, there's a specialist product that they make, which is for teeth whitening. Obviously, there's thousands of teeth whitening products, some that you can get off the shelf. This is a specific type that can only be administered by dentists. It's far more effective than what you'll find off the shelf or in chemists, and has been quite successful for them too. Finally, they do make sort of the machines or applicators that sort of are linked to their products in terms of being used by dentists for mixing. So they're very specialised. There's thousands and thousands of different products and items that a dentist might choose from catalogues from different providers. SDI very much focus on those narrow ranges.
Yeah, I think we've had Samantha Cheetham, the CEO, present, I think, once or twice here on Coffee Microcaps over the years. Been a while since we've had her on. And I do remember, this kind of slow decline of amalgam. She was even talking about it, probably 3, 4 years ago. And they were expecting that to, just continue on. And, new products were kind of kicking in to kind of replace it. In terms of an inflection point, is that what kind of got you interested in the business, that the old amalgam business would disappear, and these new products kind of kick in and drive the revenue on?
Yeah, I got into it for various reasons. I've been in and out of it for many times over the last decade. Sometimes as a value play, it's often sort of forgotten. It's only got $100 million market cap, which probably isn't quite enough for a lot of funds, especially when you couple that with its illiquidity. It's tightly held by the family and other large investors, so it's not all that easy for a fund to get in and take a substantial position. Um, that has initially attracted me to it. I feel that it's more of a growth story now, because of uh, the fact that they've managed to cement after probably a few years of up and down results, cement some decent consistency in their profits. And that's led them to taking a significant new step, which is and this stems from my own visitation of their facility at Bayswater. I could see that they've essentially started very small at that facility in Melbourne and added on bits and pieces as they've grown. such that they've essentially got almost a rabbit's warren, uh, essentially unsuitable property for what is a really high tech business. In the last few years, they've bought property further out in Melbourne at Montrose, and they've built a large new warehouse there. And they're in the second phase now, building a significantly larger second warehouse and production facility on that site. That, for various reasons I won't go into here, is going to unlock really significant efficiencies. You often hear that from businesses, but having seen the site and them pointing out very specific examples of improved automation and production capacity, it's clear that that's going to be a really massive step for this business. So that's where the inflection point is. I also like it because I think I look for businesses where there's some hidden aspect that I don't think is obvious to the market. We've sort of touched on it here in that revenue has been fairly flat to the naked eye when you're talking about what you claim is a growth business, but in ultimately that is masked by the fact that that core product of amalgam is continually going down. It was made a bit messy because demand actually went up during COVID for amalgam
I remember
briefly,
that, yeah.
but essentially it's a downward spiral really, and that masks what is actually impressive growth in their replacement products in what they call aesthetics, which has really been a very good, steady growth. Again, it's masked due to some messiness around foreign exchange. They supply that product literally to everywhere, every continent on the planet. So that makes it messy. But essentially, over time, there's really good growth in both the whitening and particularly the aesthetics. So that sort of mix of things has attracted me to it.
Yeah. And I think it's worth touching on as well, if I remember correctly, one of the other attractiveness of this new warehouse was that they wholly own their other warehouse, or the original facility, which is going to be surplus to requirements, once they move everything over and get the new premises set up. So there's questions around, what's going to happen to that. Is it going to be sold? What's going to happen with the capital? Maybe just touch on that from the value aspect of it.
Absolutely, and I think that this capital management part is really what's holding a lot of people off. They provided some clarification to that only a few weeks ago. Um, so the new facility is going to cost a fair bit of money for a company this size. They've already got 20 million in debt from the building the first facility. They're producing NPAT last year and again this year of around $10 million. But they're going to need around 40, $50 million in further capital before everything is done, including new machinery. Um, so the markets has sort of been expecting a capital raise. The family have no real interest in being diluted, and they confirmed a couple of weeks ago that they don't intend to raise capital, that they will fund the new facility through debt and through a sale and lease back of their existing facility in Bayswater, which is quite a significant piece of land and industrial property. So there's up and downsides to that. The upside, obviously, it's great not being diluted. There won't be this capital raise, at least at this stage, that a lot of people are expecting, and that might cause people to slowly buy on market to get exposure. Against that, at its peak, net debt will be fairly significant for a company of this size. So that creates risk. Obviously, there's a hiccup in profit one year that will make the market more nervous than it would otherwise be. But I think at what is still a very low multiple, under 10 times NPAT for a company of this longevity and quality and with some unique products and a great R&D um, basis to it is taking all of that into account and still leaving you in a very good position, I believe. That debt, although it will be significant at a certain point, will still be backed by this very large property, which will, my calculations, be worth about what the net debt is. So it's essentially property backed debt. It's not like the debt necessarily that you would be taking risk on when that's borrowed by a company that solely had non-tangible assets, for instance. So,
Mm,
and as I say, there's a very high chance it will allow a significant uptick to that current profit level.
yeah. And we're, pushing into reporting season, and SDI obviously doesn't report a 4C being a, profitable dividend paying company. So we'll get their results the end of August. I mean, what's the key thing you're looking for here? Is it that, where Amalgam sits as a percentage of total sales, or is it, where reiterating what they've said they're going to do in terms of sale and leaseback, or maybe there's an update on that they've, engaged an agent and they're actively talking to, potential parties to facilitate that transaction.
Yeah, it would be good to get some further capital management update. I'm not sure they'll have advanced to that point of actually getting close to a sale of the current property, or having engaged an agent. But uh, you can do your own sort of assessments by comparing other property in the area to get a feel for what it might be worth, and it will go a long way to paying um, the new facility. I'll be looking. They've already flagged or given an update or a forecast on what the full year profit will be, which they say will be between 10 and 10.4 million NPAT. That is a really good second half after the first half was only just under 4 million. It typically does have a second half bias to earnings, this company. So I think there may be some disappointment, but that was flat on last year. As I say, last year benefited from this final sort of COVID uptick in amalgam sales. So amalgam sales have dropped 20% this year. The other parts of the business have improved. Um, I'll be looking for the gross margin, which they've currently flagged being in the low 60%, and any commentary we can get around how that might improve or is improving through the purchase of the new machinery, and even the first of the warehouses that's being built out at Montrose. They probably won't give a forecast or an update, but any sort of commentary we can get will be useful.
Okay, one to keep an eye on, for sure. Sounds like there's a lot of kind of moving parts under the hood there. Second one we want to move on to is, we're going to flip completely now from healthcare into financial services. But another example, microcap business, profitable, paying a dividend. Fiducian Group, for anybody who hasn't come across these guys. They've also presented at our two of our events in Sydney, I think. I'm not sure if we've ever had them on a webinar, but they've definitely presented at our in-person conferences in Sydney. So maybe anybody who hasn't come across Fiducian, just give us a quick overview of their business.
Sure, and again, they share some characteristics beyond the fact it's profitable and dividend paying. It's a family-run business. The Singh business founded it, and Indy Singh, the founder, is still heavily involved as chair of the board. It is and also that it's a business that is tightly held, very illiquid, although it is much bigger than SDI, having a market cap of around 340 million. So it's a business that you perhaps best describe it as almost a vertically aligned financial services provider, in that at its core it owns and franchises various financial planning groups around Australia, um, or offices. Some franchise, some they sort of employ directly the financial advisors. Um, but that has been grown upon over time, such that they have very significant businesses, not only in the financial planning, but in the management of money. So they have a core set of products that essentially fund products for their clients to invest in. They tend to be fund to fund type products, which can be problematic in some cases. But what sets Fiducian apart in that area is the fact that it's been around for so long. it's built up a very high degree of trust from consistently doing very well for their clients over many, many years now. Um, and they're not cynical in the way that they put together those funds of funds. The fees are very fair, and they are really good value for money for what they provide, in my view. Um, so that's the funds management aspect, and then finally there's fund administration. So they will look after funds both in the administration and management part of the business, not only for their group of financial planners, but they'll manage and administer funds from the other thousands of independent financial planners there are. Um, the final part of the business, which is a brand new part of the business, is and still in very early stages, but they're using that sort of that role they have in the ecosystem to see how they can go competing with the likes of much larger companies in terms of, say, Hub, and that is in the development of a platform. So a platform whereby, um, in addition to the software they provide, financial planning software, they also are developing a platform whereby financial planners, both their own and outsiders, can basically manage and or create access to a wide range of financial products for their clients. So I won't talk too much about that now because I see that more as a free option upside. But the other part of the business, the three other parts of the business, um, result in them having funds under sort of uh, uh, administration and management um, that are really quite significant for a company its size.
And what kind of attracted you to the Fiducian business? At the start, is it just, they're kind of one of these, it's a great term in investing these days, quality compounders. Everybody's looking for these quality
Yeah.
compounders. But I think, I think knowing the Fiducian business and listening to a few of their presentations, and as I said, they've presented a few times now. It does have a lot of those characteristics of, they know they've been around a long time, they stick kind of to their knitting, but at the same time are not afraid to innovate within their space. And, they just kind of slowly build on top of build on top of build. They're not, doing, I haven't recalled them anyway doing, loads of acquisitions and trying to, put two and two together to make, to make five.
Exactly. They've grown organically the whole time. They have, occasionally acquired books of work from financial planners, but no other major business that they've acquired. They've just slowly and steadily built this business, and they've consistently done what they say they're going to do. At its core, the thesis for this investment is operational leverage, which is hardly novel or all that revolutionary. But a lot of companies talk about operational leverage without achieving it. In this case, the operational leverage comes from the fact, as it does with most funds management businesses, the fact that the more you have under administration or management, the higher the income from fees, as generally as a percentage of that those funds under administration or management. Um, and they can increase, and in Fiducian's case, have increased at a far higher rate than the relatively fixed costs that go with the business. And so everyone obviously aims for that. What Fiducian really have done is over many years now pointed out how they intend that to happen, and have consistently made it happen. And I am attracted to it now, even though the share price has done well over the last year or two, um, because I partly because of the market and the free kick they sort of get from the increase in funds from an increase in stock markets around the world. Um, I see we're at a point with them where there could be a sharp increase as soon as this half, or certainly next year on the back of the higher funds under administration and management figure that they'll report, whereby there'll be a really significant kick in that revenue without the cost going up too much. And I think you should see some reasonably good profit growth in the next bit. And I don't think it's something the market's really got itself on top of at the moment. Being in a liquid stock, its potential is to increase sharply if the market suddenly takes notice. And it's a stock, because it's family owned, that is very keen on rewarding investors. They've consistently paid a really good fully franked dividend. They don't hoard money, yet having said that, they still have 30 million in net cash and no debt. So, it's a probably less risky proposition than SDI.
Yeah. I mean, this whole space, financial planning space, I know they do, a bit more than that, but it's been a very dynamic industry in the last 2 or 3 years. We've seen a few takeovers, in the listed space, and there's a clamor for financial planners, the few that are kind of remaining in the industry. Everybody wants to get them under their banner group, if they can. Fiducian, a takeover target, a consolidator in the industry. Is that part of their future, do you think?
Yeah, I think that could be a takeover target. I think they'd be attractive to a larger firm. Uh, I don't know if they would be a consolidator. I think one thing that sets them apart from some of the other listed and even unlisted financial planning groups is they've been very keen to have control over how their uh, planners operate, ensure they operate at a really high standard. And I think they've been successful in keeping themselves well away from any scandal or any problems that even as recently as the weekend we're seeing with some of the other listed operators in this space. And so I don't know. I think they prefer to grow by attracting independent planners to use their platforms rather than being a roll up of actual other planners and the messiness that comes with the licensing of those. But yeah, I think that the funds they have under administration and management now are getting quite attractive as someone else, a larger firm that wants to consolidate. And I think some of their platforms and tech is not at the moment a massive threat to anyone, but at a certain point, I think will become interesting enough to a larger player that it's you know cheaper for them to acquire rather than compete against.
Yeah. Um, so again, they'll be reporting now the back end of August as well. Um, Things you're looking out for, is it that fund under administration, or funds under management, whatever they call it, at
Yeah,
the group level, in the various different product divisions, like what that has increased in totality. Is that kind of the key number to look out for?
yeah, it is, and so we're hoping that will show a bump, that there's a good funds inflow, but also the bump I'm hoping for and expecting from the generally good market conditions that we saw in the fourth quarter. They'll usually give us sort of July update, and again, there's no reason to think that shouldn't be quite good. And essentially, you can the and it's an attractive part of this business is that the revenue and profits are reasonably predictable from the prior year's FUM figure or under administration figure. So yeah, forward profits are therefore you're looking at how they're going at growing that. And yeah, why I'm interested is I do think that they're probably at a bit of a growth spurt at the moment with that, and that will sort of lock in good profits for the coming year.
Yeah, I think if I remember one of the slides when they were here before, the other I think attractive thing about Fiducian's business is that the funds that they have a long track record themselves. So it's not it's not a division they suddenly started. They can show a 3, 5. I think some of them have even been going for like 10 years, maybe even longer. I think it was there a 15-year one in there. That's
Yeah,
quite a long.
absolutely.
There's not many businesses that can point to a 10 or a 15-year track record, and if it's a decent one, it's hard to ignore from a financial planner's point of view when you're like looking at these, what do they call them? RPL's recommended product lists.
Yeah, that's right. And not only that, it's it's part of that list. And this is a question that comes up a lot with Fiducian, and rightly so, is this idea of a vertically aligned business where you have planners advising their clients to go into products that are developed by the same firm, and that has been looked at in the past. That seems to have settled right down from a regulatory point of view. In any event, in Fiducian's case, that longevity that you're talking about and the proven high performance over many years really makes it easy for those planners to justify this as a legitimate product, notwithstanding it's that you could argue otherwise that there's some level of conflict there, but it means that there's no real concern about that aspect.
Yeah. Peter, thanks very much for coming back and joining us again. I know you've self-removed yourself from X or Twitter these days, but the way much to the entertainment value of my of my Twitter feed. But I think Westferry, the brand, is still alive and well on Twitter. But if people do want to kind of reach out and get in touch and find out more, should they email you? Check out the website. What's the best way to get in touch?
Yeah, that's right. Twitter was rotting my brain, as fun as it was occasionally. The website westferry.com.au has a lot of video content. We've moved to a monthly video update now, and that
Yes, I remember.
includes obviously me talking about our portfolio, but I'm going to start include interviews with CEOs of some of our larger listed and unlisted positions. Not wanting to cut your grass, but it's just I'll focus solely on my portfolio. Um, and yes, otherwise, people are very welcome to email me at the details you'll see on the website.
Okay, perfect. Peter, thanks very much. We'll leave it there and yeah, good luck for reporting season.
Great. Thanks, Mark.